I think that the economy, certainly in the US, is stronger than people expected. And it could, on an underlying basis, be stronger in Canada than people expect as well. And that's going to obviously have ramifications for rates and how much the Bank of Canada cuts.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. All right. Welcome back, Mr. Rob McLister. It has been well over 2+ years since we've done a podcast together. And I can say I'm excited to have you back. And I appreciate all the mustache compliments you gave me before the show. Just grinning ear to ear, side to side.
Looking good. You got to wax up those tips, so maybe, mix it up.
We're working on it. It takes more than 30 days to grow to that point here. But at this rate, we'll be there in the next 45, I think. So Rob joins us from MortgageLogic. If I could speak, that would be better. From MortgageLogic.news. Rob runs the publication, which posts almost daily content as it relates to everything in the mortgage and real estate world. And I mean, I can speak on behalf of most of the mortgage community as a big old thank you very much, because you've made our lives so much better in taking the information we used to have to hunt for hours and bringing it to one space. So first of all, thank you so much for what you do, my friend.
Well, that's very kind of you. Thank you. I enjoy doing it. And there's always something to write about.
I always say that the best part of a career, or where you found your place in a career, is when you find something that you actually like doing, and then you just get paid to do the thing you were going to do anyways. So I'm sure that feels great. So what's top of mind right now for everyone, obviously, as it always is interest rates. But before we get into the specifics of interest rates, something you've written a lot about lately, specifically over the past, I'd say 4 weeks more than in the past before that, was the U.S. and its impact on Canada, obviously triggered by the election and the events that are about to occur and have not occurred yet in Canada and in the United States, but the concern of what's going on there and how it impacts Canada. So my first question for you, Rob, is knowing the fact that first and foremost, while Trump is elected, he's going to be taking presidency in January of 2025, and the markets have already had a relatively significant reaction already. Do you anticipate markets to react even more substantially in January, or are things kind of set in stone? And what could be the possible outcomes over the next few months here as it relates to mortgage rates?
Yeah, I think it's going to be an interesting first quarter. We're going to get lots of new information that we don't have today in terms of Trump policies and a whole bunch of stuff. how inflation's going to do. I think we'll probably see inflation hold up a bit. We got some base effects that are kind of propping it up. And so, I don't think that we'll make significant progress on inflation until later in the first quarter. And that depends on what happens with Trump. So, like you say, what happens in the U.S., I don't think Canadian mortgage practitioners and Canadian mortgage borrowers, for the most part, fully appreciate or spend enough time looking at what's happening in the U.S., because it really does guide our market here, mortgages and real estate.
Well, let's talk on that for a second here. And you've highlighted this a lot in the last few weeks as it relates to the Treasury compared to the Canadian bond, and a variety of other factors, specifically highlighting government spending and its impact on both of those items. Maybe it's just me, and it's not something obviously new, but you're right. It certainly has been something that has been highlighted a lot more in the last couple of weeks and months, specifically more so than I would have ever heard 10 years ago or 15 years ago at this point right now. Are Canadians just waking up, or just people like yourself just spotlighting this fact and bringing it to light, and which is helping us to understand why this is such a big impact on Canadian mortgages and real estate?
Yeah, economists, professional economists, bond market traders, professional investors, they all understand the link between the U.S. and Canada. And, this is not new. The correlation between U.S. and Canadian rates, if you look at the 5-year, is, high to mid to high 9.9 region, which is extremely high. You're out of, on a positive correlation, you're out of 0 to 100. So we're pretty close to 100. So, in other words, U.S. rates and Canadian rates generally move like train tracks. So looking at kind of like a 30,000 foot view, real estate demand, as comes mainly from things like population growth, conversion of renters to buyers, investors, that type of thing. And, economic growth and interest rates are two primary factors driving, renters turning into home buyers and investors and, buying rental properties, et cetera. And, like I said, the U.S. is the number one influence on Canadian interest rates and the Canadian economy in general. And, we can talk about why that is. I mean, obviously the Canadian economy is a very, very close partner with the U.S. We're America's top trading partner. I think over half of our imports come from the U.S. and 3/4 of our exports go to the U.S. So, if U.S. demand and inflation surges, then ours picks up too, and vice versa.
That was a good explanation there. What a lot of people have asked me lately, and where I've had a lot of questions when I've been trying to relay this information, is really a lot of confusion around, Trump was elected, but he's not in power yet. And we haven't seen him do this spending, and we haven't seen these taxes come into place. So why are the markets reacting the way that they are right now when none of these things have actually occurred at this point right now? Why is that the case?
Well, traders are paid to speculate. So they look into the future, they try to parse all of the incoming information, and they translate it into a price. And, traders, investors battle it out every day, every minute to figure out what is the optimal price based on what we think we know about the future. And so, what's going to happen in the U.S. in terms of policy is huge. The Republicans swept Congress and the presidency, and that's widely seen as inflationary because, it'll be easier to ram through things like tax cuts, pro-growth policies, tariffs, that kind of thing. Now, the great unknown is, how much the U.S. reins in the deficit and, how much tariffs eventually slow the economy, because those things could potentially offset some inflation, and the market's still trying to figure that out.
There appears to be almost like this separation right now between Canada and the US. And I don't know if it's real or not, or if it's being propped up probably at this point right now. But the US, the numbers continue to come in and report relatively strong from what I've seen so far, whether it be inflation, spending, or the latter. We're still seeing it's almost like the country itself is operating from a distance, at least from my perspective, decently well by all accounts. In Canada, obviously, as you know, the data keeps coming in worse and worse and worse and worse, yet it looks like we're almost being dragged up or propped up by our US counterpart. Are all these data points in the US, is there a cloud of mystery as to whether or not they're real? And are we going to see things start to tumble back down and impact us here in Canada relatively soon? Or is this a situation where Canada is just going to end up being pulled up to a point at which point it's going to have to make a decision as to whether or not it wants to separate itself significantly?
So first of all, let's understand again that linkage there. There's a macroeconomic linkage between Canada and the United States. It's like 0.91 GDP correlation between the two countries. So we're really tight in terms of economic performance. And, right now in the US, there's, the labor market is reasonably strong, especially after the, monumental rate hikes we had. In Canada, the labor market isn't exactly falling off a cliff. And, inflation's coming down. We're at 2% now, around the target. So we've achieved that goal. And so right now, one of the things I look at actually is one of my favorite indicators to kind of give me a sense for what the bond market's thinking is this thing called the Citi Financial Surprise or Economic Surprise Index. And I watch it for United States and Canada. And, on the US side, the surprises have been positive. In other words, the economy's outperformed expectations. And if you look at the Canadian indicator that Citi puts out, we're starting to improve too. And, you see the leading indicators at OECD turning higher for a while now in Canada and the US. So I think that the economy certainly in the US is stronger than people expected. And it could on an underlying basis be stronger in Canada than people expect as well. And that's going to obviously have ramifications for rates and how much the Bank of Canada cuts.
Yeah, I mean, that's interesting feedback. Anecdotally speaking, just looking at the conversations that I have every day, I would argue that's not the case. And I work with clients who I would consider to be above average income levels on a regular basis. I was just on the phone with, as an example, a family where they make and generate $250,000 of gross income annually. And quite frankly, they have a mortgage of about $800,000. And they were saying to me, like, we have a hard time saving money. Half of our money, just black and white, half of everything X person earns is taxes. And once it's all said and done, I'm paying this. She's like, Alex, we're calling you to refinance right now. And we don't even spend a lot of discretionary money on random things. This is crazy. Like, how do we get out of this pit? I'm sitting there thinking to myself, okay, how is the economy supposedly doing well when I have a person earning $250,000 saying something like that to me?
Well, we're not gangbusters. So, we're maybe around 1.3% GDP right now. US is more like 2.6% if you look at Atlanta Fed estimates. So the fact is, though, that on a macro basis, based on everything we've been through, we're holding up a much better than expected. Now, that's not to say that, if you're making, a couple $100,000 a year, it's easy sailing. There's actually a lot of challenged folks that live in Canada that make that kind of money. And its cost of living's high. There's a giant vacuum out of Ottawa sucking money out of your wallet with every paycheck. And it's hard to get ahead. So yeah, you hear folks all the time. I hear folks all the time that are really struggling. But on a macro basis, the economy is, I would argue, stronger than we expected it to be at this point, say, a year ago.
Yeah, it's interesting, man. I almost feel like and this is a little bit off topic here, but I almost feel like you've got kind of like, obviously those are very low income, the kind of medium income. And then this funny little part right here where families earn between, let's call it 150 to 250 that are getting hit the most, more than anybody. And then obviously you've got the kind of wealthy above of that crowd. And it's funny because, not funny, it's kind of sad actually. It's those folks that I meet in that income gap of 150 to 250, whatever range. Those are the ones that seem to get hit the hardest, obviously. Taxes, life expenses, you name it, that kind of stuff. And those are the ones staring at me saying, like, what are you talking about? Rates aren't coming back down. This is insane to me, right? Anyways, one other thing that you pointed out on an article recently was about the fact that economists appear to be having a conflict in, and this wasn't your word, this is my version of it, but it appear to have conflicting feedback as to where things are going and having a harder time than ever trying to determine what's going to happen in the next 3 to 6 to 12 months right now. It's always a guessing game when it comes to economists trying to figure out what's happening, what might happen, what could happen. Heck, we sit here and say, okay, well, based on what those guys are saying, this is what might happen, this is what could happen. I've never seen such a wide variety of different outcomes that I can think of, at least in the last 10 years. And you could tell me if I'm wrong, but I don't remember seeing anything where they were just so far all over the place. What gives? Like, why is that the case right now?
It's uncertainty. It's like if you look at a stock and you have a stock that just goes straight up, you'll notice that on that stock chart, there's a lot of zigzags around the top. It's because that's a point of maximum uncertainty. And so people are buying like crazy, they're selling like mad, and you get a lot of noise. And I think we have a lot of noise right now because I don't think we have enough information to feel confident about where the market's really going. I was watching Bloomberg this morning and there's someone talking about rate hikes next year. And, imagine that. And where did that conversation come from? This came out of left field in the last month or so because the economy's been outperforming. And, the fact is that economists are usually behind the curve in terms of where the economy and rates are going. There's nothing that takes information and processes it better than the market itself. And the economists are more dovish than the market itself at this point. There's no question. There's a number of economists out there, Bay Street economists, that expect the Bank of Canada rate to undershoot the estimated 2.75% neutral rate, maybe drop from 3.75% today to 2.25% next year. Meanwhile, the market only expects 100 basis points of cuts. So we'll find out who's right in about a year or so.
So that's actually a point one of my next questions that I was going to bring up. And I get this question asked to me all the time, but I'd love to hear just your answer on this. So we talk in terms of the markets, the forward markets, and a lot of our listeners to our podcast are just starting to learn about money in their journey. They're trying to understand it, whether it be real estate investing or just getting a better grasp over how to break these terms down and explain it. So when we talk about things like forward markets and you're pulling up an analysis, first and foremost, how is this information put together? Where is it all coming from, right? And who's putting it together in the terms of these percentages that you're utilizing for your data?
So, about forward rates. So forward rates are contracts, essentially to secure a specific interest rate in the future. So they reflect market expectations or where rates are going. And people or big investors use forward rates all the time to reduce risk by locking in borrowing costs today for future loans and investments and deposits, things like that. So on the mortgage side, we use forward rates to project where rates might go based on the market's consensus view. Okay. And again, it's not perfect. It's going to be wrong a lot, but the market is usually right in terms of direction. And so the odds are that rates, the market thinks right now that rates are going to come down a bit more and further out start going back up as monetary policy and rate cuts and whatnot start working and the economy picks up steam. So we take that information, we plug it into a model, and we do this at MortgageLogic. You've probably seen it, where you can put in future potential rates based on market expectations. You take that and you add it to interest rates today for all the mortgage terms. You make some basic assumptions about what could happen when people renew, and you let the machine tell you roughly what the lowest potential borrowing cost is over the next 5 years. Is it a 5-year fixed, a 3-year fixed, a 1-year renewing into a variable? We have all these different combinations. And at the basis of that is the market's expectation for future rates.
And you're referring to your amortization simulator in that sense, right? The tool
right.
that, yeah. Okay, perfect. Well, when you talk often about the rate market, a lot of people obviously talk about yields. You commonly speak to the 4-year swap when you're running your articles and feedback. Can you explain why that is? Why you use that as an indicator of where fixed rates are and where they're going, as opposed to the conventional 5-year yields in the sense?
Yep. So a swap is a tool that lenders use big banks use to manage interest rate risk. So swaps basically let you take a fixed mortgage payment and convert it to a stream of floating rate payments. And those floating rate payments are easier for a bank to fund, since most bank funding comes from short-term sources like, checking account deposits, short-term savings, overnight lending, that type of thing. And so, we use swaps here at MortgageLogic because they're better fixed rate indicators than bond yields alone. And that's true for a few reasons. Swap rates rather determine, the actual cost that banks face to hedge their mortgage funding. Swaps, reflect credit and liquidity risk, like the risk of, one bank defaulting on its obligations. Swaps are not as distorted by things unrelated to mortgage funding, like quantitative easing, that type of thing. So, and there's lots of different swaps. We use the 4-year swap in particular, whereas people use the 5-year Government of Canada bond yield, generally speaking, to kind of get a sense for where rates are going. We use the 4-year swap because that 4-year duration most closely matches the actual effective length of a 5-year fixed mortgage. And, that average 5-year fixed mortgage, for example, lasts somewhere around, 3.8 to 4 years, depending on where rates are at, because people pay off their mortgages. So that's why we use the 4-year swap.
That's a really good explanation. Thank you for breaking that down. And that leads right into that next point about Canadians making mortgage decisions or making decisions on their mortgages when they know they're going to be 3 to 4 years, or they don't know they're going to be 3 to 4 years out of 5 years. I'll lead into the question here. Canadians right now are having a very difficult time making a decision on a mortgage when the variable rate is so darn close to a fixed rate. And we just touched on a few reasons why it may or may not go down in the near future. And we look at a tool like an amortization simulator, which we discuss with our clients all the time to give them a better idea of where rates can go right now. But I'm hearing more noise, if you will, now about Canadians asking the question, should I start to look at a 5-year fixed now for those conservative Canadians who don't feel comfortable looking at the possibility of taking a variable or even taking a 3-year knowing that rates could go up? First of all, outside of the prepayment penalty concern of not making it to the end of 5 years, is there logic in Canadians starting to do that? And are you hearing more noise, or are you hearing more people start to consider the conversation of variable more in their chats?
So here's what we know, right? Inflation is sticky. Inflation is already back to target. Employment, like I mentioned earlier, is still reasonably solid. We have all this potential risk coming out of the U.S. with tariffs and immigration cutbacks, that deportations that could, drive up wage inflation, that type of thing. So there's certainly more risk today than there was 3 months ago. And people have been, looking at the newspaper headlines, mortgage rates are going to come down, Bank of Canada is going to keep cutting, yada, yada, yada. And that is right until it's wrong. And so as we go into the first quarter, we're going to get more information. There's a very good chance that rates don't go down as much as people thought they would. Now, we can't predict the future. Anything could happen. Putin could threaten nuclear war tomorrow, and all of a sudden, the entire world's pouring into U.S. treasuries for safety, and yields just plummet. Right? We can't predict that stuff. But out of high probability events, most likely, rates are going to come down a bit because the economy does, like you mentioned earlier, does have underlying weakness, and then hit a point where there's some type of support, and then something else, something new has to happen. Some new catalyst has to come along. And maybe that's Trump. Maybe that's his pro-growth policies. We don't know. So to answer your question, so folks that are looking at all this and maybe don't have a lot of breathing room in their budget need to protect themselves. And term selection is about risk management. And so what are my choices? I can go with a variable, float, and that was a great move, a little higher up when before the Bank of Canada started cutting as much. Or I could look at a 3-year fixed. And incidentally, the 3-year and the variable, if you plot this out on that amortization simulator, the projected borrowing costs over the next 5 years, assuming you take that 3-year and renew into a variable, are pretty close. They're within the margin of error. So, and then you have the 5-year fixed. And that traditionally has been the most popular term in Canada, not so much today. And, but there's also another choice, and it's called a hybrid. And so that's where you take, put part of your borrowing in a variable, part of it in a fixed, and then you're basically hedging interest rate risk. And from an academic standpoint, you talk to a professor at like Moshe Milevsky, the godfather of rate research in Canada. He's supportive of that product because none of us are smarter than the market. None of us can see 2 or 3 years ahead. So, long-term variable wins if you look back in time, right? And if you take a portion of your borrowing, assuming that this is suitable for you, for some folks, 5-year fixed is the only option. But assuming you're an average borrower, you take a portion that you feel comfortable with and float it. And then you take a portion, put it in fixed. And this assumes you can get good rates, right? All the decisions center around what type of starting rates that you can get. That's a big factor, not the only factor, but a big one. And you choose the amount of risk that you're willing to take, and you line up those terms. You don't want to get like a 5-year variable with like a 2-year fix, because you got to renew that 2-year fix, and then the lender's going to hold you over a barrel when you come up in 2 years. So you want a 5-year and a 5-year. Then you can do your best to set yourself up for a success on at least a portion of your borrowing.
I see what you're saying. Yeah, and I've talked about that with my clients as well to give them an idea of this type of concept. I think the point that you just mentioned there about not having conflicting terms is massive, though, because as you know, the lenders at that point are like, hey, you can go nowhere unless you're going to pay us a fee or a penalty to get out of there. And I see that all the time. absolutely all the time. Rob, I know you only have so much time here left with us today, and I have a few quick points that I want to cover with you as it relates to the go forward. So rates going forward, obviously a mystery, a cloud of dust. My one question is, if you were to kind of pull out your magical crystal ball, because I know you have one and you just haven't shared it with all yet today. We know we've got this renewal wall coming up, and I'm getting a lot of calls about renewals. Let's be honest here. We've got rates that are holding steady and they're not really going anywhere. We've got condos galore. And, if you listen to some people saying Toronto's just a mess and Vancouver's a mess, but everywhere else is busy and no one can figure out what's going on. What do you think is in store for the first half of next year as it relates to real estate? Do you think that this all compounds to a whole bunch of demand that's been held up for a long time that's going to explode? Or do you think with the fact that all these people have to, renew and there's all these empty properties that it's just going to end up being an exchange and we're not going to see a lot of action there?
So rates are still relatively high. We're about 100 basis points above the 20-year average for your typical mortgage rate. So, folks are going to be coming up for renewal and they're going to be paying higher rates than they got at origination. That's going to have a slowing effect. And there's not as much rate-driven demand as there was in prior years. So, but looking ahead to the first quarter, again, a lot of it depends on what happens with inflation and the outlook, because, if, for example, the market looks at these Trump policies and decides that, this is crazy, these are inflationary, fiscal spending is off the rails, that, there's mounting credit risk, even though the United States is, supposed to be a risk-free bond market, there's a chance that rates could tick higher because yields take rates higher. And we're talking specifically on the fixed rate side here. But on the variable side, the central banks have to take these same factors into consideration. But if you're looking at an average rate, there's risk going into 2025. And, the thinking has been that rates are going to go down, and so the real estate market's going to be strong. And we're going to have an amazing first quarter or spring market, and that could happen. It's just that, like I said earlier, there's more risk now than there used to be. If you think that falling rates are great for real estate, then the reverse must also be true. So rising rates are not so great for the market. We're going to get some tailwinds here from 30-year amortizations coming online December 15th, and the $1.5 million insured value limit, the increase to that from $1 million. That's going to help demand a bit. There's some positive sentiment from that. But we have to kind of wait and see how things play out with the inflation outlook. Employment's a huge factor in the U.S. The Federal Reserve targets full employment and inflation, not just inflation. In Canada, our overriding mandate is inflation, but the Bank of Canada looks at employment as well. So keep watching. If you can only watch a couple factors or a couple metrics, that is unemployment, employment growth in the 25-year plus segment, which are correlated with housing demand more than regular employment. The core inflation, PCE, we got PCE coming out tomorrow in the US. That's a huge one. And core inflation in Canada. And the central banks look at that 3-month metric. They look at the 6-month and the 12-month of the core inflation. And we're going to have in the next week or two some really big data points that are going to determine how much the Bank of Canada cuts on December 11th.
So basically, wait and see. We'll see what happens here.
Yeah.
And there's a lot of reasons for it to go up, and a lot of reasons for it to go back down, is what I'm hearing from you, more or less.
Yeah, there's just more risk in 2025 of rates actually, flattening out or increasing.
Makes a lot of sense. Thanks for the explanation there. This is a question that I think a lot of maybe people in the industry are asking, but I'm just genuinely curious. As someone who spends a lot of time educating consumers, specifically online through YouTube, social media, and multiple other platforms, one of the things that I've noticed in the last couple of years, and specifically I think it stood out to me in the last, say, year and a half, is that consumers are getting more information than ever before from a variety of sources, whether it be like Reddit, YouTube, podcasts, Instagram. And I get gratefully speaking, I get a lot of questions from a lot of people as a second opinion question, like, hey, I saw this somewhere. What are your thoughts on this? And the crazy thing to me is that so much of this information is just not accurate or not correct, or it's not in context, whether it be rates, terms, Do I do this? Do I not do that? And so I guess the question I have for you is in an age where information is everywhere, where people can click a button to get their mortgage like they used to get their insurance, first question is there too much information out there for the average Canadian consumer? That's my first question.
So the thing is that there's just more to know today to make an informed mortgage decision. And there's, like you said, there's so much information out there. It's really a question of how you boil it down to the information you actually need. And, fortunately, it's never been, there's a lot of information out there, but it's also never been easier to get answers. Now, will those answers be accurate? I'm thinking like AI and the hallucinations and all that stuff, that more and more people are using that to get their information. Or will that information apply to the borrower's circumstances? These are types of things that you actually need a professional to kind of sort out for you. That professional might not be a real live human being. It might be an AI bot in the future, somewhere down the road. We're not there today because, the information. I research stuff on AI all the time, and I can tell you that there's a significantly high error rate with the information still. And so, yeah, there's a lot of information out there, but are you going to have enough knowledge to not misinterpret the information?
Okay. So what I'm hearing from you is that information is there's a lot more of it out there. It's a little bit easier to digest, or a lot easier to digest when it was out there, but there's still a lot of wrong information that's incorrect that may not apply to someone's information. My feedback on that is I've specifically noticed that more information obviously doesn't necessarily mean, as you mentioned, better information, but it can also cloud your mind, especially if you don't know what questions to ask. It's like ChatGPT. If you don't know what questions to ask it or what prompts to give it to ask you, then you won't get the desired outcome. And so it appears to me that it's just a different way to get to things. And I love the fact that most consumers are coming to me more prepared and more educated, because it actually allows me, as someone who's an information gatherer or an education-based broker in this case right here, to be able to say, okay, you've got this information. Here's how to make a more informed decision now at this point right now, which leads me to my last question. And it's something that you've talked about before, which is, from a consumer perspective, where is the value now in working with a licensed mortgage broker versus going through your online bank or through trying to figure this out on your own? Is there still value knowing that no longer are we only able to achieve the best rates? Certainly sometimes, but there's more to it. From your perspective, what does that look like from a consumer standpoint?
In a perfect world, you would be able to go to a bot, and this bot would have all available information, all the best mortgage rates from all the lenders, all the guidelines. It'd be able to, ask you some, pertinent questions. You'd be able to answer them, and it would tell you the best mortgage for you. That thing doesn't exist today. It will exist in the future. I'm sure of it. I don't know when. I would have thought it would get here a little sooner than I expected, say a few years ago, but it will arrive. But for now, humans are your best bet. The key, though, if you're a mortgage originator, is to convince consumers that you are the best information source. You go to Google. A lot of people put more faith in Google than mortgage experts, but you are the best information source. That's what you have to convey, and you have to make people think that you're not going to just sell them something. You're going to provide education, which is what you do. You do an amazing job at that, in educating consumers instead of just necessarily selling them stuff or, driving them into a particular product. And so folks have a lot of skepticism, and that's why they turn to things like Google instead of just calling up the neighborhood mortgage broker. But if you're a mortgage broker that truly cares about folks and you really try to do the best for folks, and you don't try to just necessarily sell the product with the highest commission, but the product that is most suitable for the consumer. And, in some provinces like Ontario, that's law. You got to do that. And, then you're going to be successful because folks can sense that, right? And I think making that information easy to get and quick to get is the key. And if you can, if someone can go on your website, click a button and say, I want to talk to you at 3 p.m. today about mortgages. And they click that button and you show up at 3 p.m. and you say, hey, listen, how can I help you? What are you looking for? And then you get into that trusted dialogue. They can see your face. You're not just a name and an email or on a website. That's where there's tremendous power. And, you're not going to get that for many, many years from ChatGPT.
Yeah. Well, we'll eventually get those video AI bots coming around here. We'll see when that happens, and
Yeah,
then we'll
hopefully
create
those are
our
5 or 10 years off.
likeness. Yeah, exactly. Thanks for the explanation. I mean, it echoes what I've always said to every consumer, which is that if you don't feel like the services or the education is what you're looking for, then definitely it makes a lot more sense for you to explore this opportunity on your own without the support, because that's the best option for some people out there. Anyway, I really appreciate you taking the time, Rob, specifically breaking down how these mortgages relate to how the U.S. I should say relates to Canadian mortgages, and obviously what your outlook on the market is going to be. Hopefully we can snag you back sometime in the next year and figure out if you were right on some accounts, or better yet, if your indications were on the right page. In the meantime, if you're in the industry, I highly recommend you go check out Rob's website and newsletter. If you're outside of the industry, then make sure to go ahead and subscribe or hit the like button so you let us know that you appreciate this content. Thank you again, Rob. I appreciate your time today.
My pleasure. We'll see you next year.